Let me ask you a simple question. Let's say you have a trading strategy that wins 60% of time. Tested it, you trust it, and you go all in. That is, you bet your entire capital on every trade of that strategy. What do you think would happen? You would blow up and go broke. What else? I mean, mathematically, at some point, you will go broke. The strategy may be fine, but not the position sizing approach. This is what the mathematicians call gambler's ruin. And as William Poundstone argues in the book Fortune's Formula, you can be the world's greatest trader or the most gifted investor, but if you can't manage how much you bet, you will end up broke. Essentially saying that the edge won't save you if your position sizing is flawed. Most traders intuitively know this in theory but completely ignore it in practice. So how do we deal with this problem of sizing correctly? Well, in 1956, a physicist named John Kelly, working at Bell Labs in New Jersey, published a paper titled A New Interpretation of Information Rate in the Bell System Technical Journal that answered this very question. Now, some of you may be wondering as to what has a physicist got to do with position sizing, and why does the title of the paper talk about information rate of all the things? We'll get to that in a while. So yes, John Kelly called it the formula for optimal bet sizing, later known as the Kelly Criterion. I would say it is one of the most elegant and the most ignored ideas in all of finance. Today we are going to understand what Kelly figured out and why it matters, and yes, whether it can be used realistically when we size our trades. I'm your host Sandeep Rao, and let's dive in. Before we get anywhere, let's first understand what this Kelly Criterion is all about. To calculate the Kelly Criterion, or what's mathematically called the Kelly percentage, we need two inputs. The first is your win rate. Simply put, out of 100 trades your system takes, how many do you win? That could be 40%, 50%, 60%, whatever your system delivers. If you win 60 out of 100 trades, your win rate is 60%. The second input is your average win to average loss ratio. This tells you how much you make when you're right versus how much you lose when you're wrong. You calculate it by taking all your winning trades, finding the average gain, and then taking all your losing trades and finding the average loss, and expressing it as a ratio. So if your average winning trade makes 2,000 and your average losing trade costs you 1,000, your win to loss ratio is 2:1. It could be 3:1, 4:1, or even less, 1:1. It depends entirely on your strategy. Now, these are the only two inputs the Kelly formula needs. Without both of them, you cannot calculate the Kelly percentage. Now, let's take an example of two different strategies with a different set of win rates and average win to average loss ratio, and see how Kelly works there. Strategy A has a win rate of 60% and a win-loss ratio of 2:1. So out of every 100 trades, it wins 60 and loses 40. And when it wins, it makes twice what it loses. If a losing trade costs 1,000, a winning trade makes 2,000. A solid strategy. Most traders would feel quite confident backing this one. Strategy B has a win rate of only 40% and a win-to-loss ratio of 4:1. It loses more often than it wins. 60 out of 100 trades are losses. But when it wins, it makes 4 times what it loses. A 1,000 rupee losing trade is offset by a 4,000 rupee winning trade. Now, intuitively, most traders would back strategy A more heavily. It wins more often and it feels safer. Strategy B loses 6 out of 10 trades, and that's psychologically brutal. Most people would size it smaller or avoid it altogether. Let's see what Kelly actually says in this context. The Kelly formula is Kelly percentage is equal to win rate minus, within parentheses, 1 minus win rate divided by the win-loss ratio. Now, if we have to calculate it for strategy A step by step, this is how it would work. The win rate is 0.6, the loss rate is 0.4, the win-loss ratio is 2, so 0.6 minus 0.4 divided by 2, that's 0.6 minus 0.2, Kelly percentage would come to 40%. On 1 lakh account, Kelly is telling you to put 40,000 on each trade. Now let's look at the next strategy. For strategy B, the win rate is 40%, that is 0.4. Loss rate is 0.6. The win-loss ratio is 4. So 0.4 minus 0.6 divided by 4, that's 0.4 minus 0.15, and that brings us to Kelly percentage of 25%. On a 1 lakh account, that's 25,000 rupees per trade. Now let's pause here. To understand how this works and what to make of it, strategy A gets 40% allocation on a 1 lakh account. Kelly is saying put 40,000 on a single trade. Strategy B, the one that loses 6 out of 10 trades, gets a 25% allocation, 25,000 per trade. Kelly doesn't care that it loses more often, but it does care about the mathematics of long-run compounding. A 4:1 payoff with a 40% win rate also leads to a positive expectancy. While the win rate may be low, the win-loss ratio more than compensates, and hence Kelly sizes it accordingly. So what Kelly tells you is the max allocation for a given strategy, beyond which your odds of blowing up your account increases. At a very basic level, if you have to remember something, it tells us that win rate alone tells you almost nothing about how much to bet. What matters is the combination of win rate and average win to average loss ratio, and together they determine your edge, and your edge determines your optimal position size. So this is the basic 101 kind of stuff, but reality, as always, is far more nuanced. We'll talk about it soon. But before that, here's a fascinating story of how the Kelly Criterion came about. The year is 1955. America is gripped by a television quiz show called $64,000 Question. The show aired live on the East Coast and was delayed 3 hours on the West Coast. Someone figured out you could learn about the winner by the phone on the East Coast and place bets on the West Coast before the delayed broadcast aired. Inside information on wire. According to notes from one of Shannon's lectures at MIT, it was news reports of exactly this scam that inspired John Kelly to ask a question. You see, John Kelly and Claude Shannon worked together in the information theory space, and Shannon had come up with something called the Shannon-Hartley theorem, a formula to calculate how much information could reliably be transmitted through a channel. So Kelly got curious if that theorem had any applications beyond information theory, specifically in the context of gambling, and Kelly found an answer. Now Kelly imagined someone receiving advanced tips about horse races through an unreliable wire. The tips gave people some edge but didn't offer 100% wins. So how much should the gambler bet? If he bet everything, one wrong tip ruins you. Bet the minimum and you waste your edge. The answer had to be somewhere in between, and that's what Kelly solved mathematically. What he found was quite elegant: the optimal bet fraction that maximizes long-run capital growth equals to Shannon's information transmission rate. He wrote a paper about it and called it Information Theory and Gambling. Bell Labs executives got nervous as bookmakers were big customers, so Kelly had to change the title to A New Interpretation of Information Rate. Shannon refereed it and it was published in July 1956. Kelly never wrote about gambling again. 9 years later, on a trip to IBM's offices in Manhattan, he collapsed on the street and died of brain hemorrhage. He was just 41. But he left behind a formula that would go on to be used by some of the greatest traders and investors in history. Back to Kelly percentage. While we now know the basics of Kelly Criterion, reality, as always, is far more nuanced, and hence I want to talk about what Kelly gets wrong. Or more precisely, what the formula doesn't account for when you try to use it in the real world. My first critique: Kelly assumes your inputs are correct. The formula gives you a precise answer, 40%, 25%, whatever it may be. But that precision is only as good as the two numbers you fed into it. And in trading, as we know, those numbers, your win rate and your average win-loss ratio, are estimates based on historical performance of a strategy. They tell you what happened in the past. They do not guarantee what will happen in the future. The second critique. Kelly ignores drawdowns and sequence risk. This is the biggest issue with Kelly. The formula treats each trade as independent, like a coin flip, which has no memory. It doesn't know you just have had 5 losing trades in a row, or your strategy tends to have losing streaks that cluster together. It doesn't know about drawdown. In real world, a strategy with a, say, 30% max drawdown means that losses bunch together, that there will be extended periods of pain before your edge starts playing out. A full Kelly allocation during such a drawdown period can cause severe damage to your account, even if you're not ruined. Third critique, Kelly is greedy. This is actually a famous critique, and it comes from the most decorated economist of the 20th century, Paul Samuelson. Nobel laureate, MIT professor, and the man who almost single-handedly made economics a mathematical science. He spent years publicly attacking the Kelly Criterion and called it a fallacy. He also wrote a short and witty paper arguing that maximizing the long-run growth rate of wealth is not necessarily the rational goal for every investor. And it depends on one's time horizon, your risk tolerance, your personal goals, that is, your relationship with money. Samuelson put it beautifully. To performance car enthusiasts, 0 to 60 acceleration time may be the only number that matters. If that were the only criterion, we'd all be driving Lamborghinis. In the real world, most people grow up and buy sensible Toyotas. So that brings us to the most fundamental question. Is Kelly of any use at all when it comes to position sizing for us as traders putting real money to work? The honest answer is yes, but as a framework and an upper bound, not as a precise calculator. For quantitative traders with systematic strategies, we have a track record. We can calculate our win rate, win-loss ratio from actual trades. Kelly is obviously directly applicable, but we need to use it with guardrails. 1. Water down inputs conservatively. Use a lower win rate and a lower win-loss ratio than your historical data suggests. After all, backtest numbers are estimates for futures, not guarantees. 2. Likewise, do not take your historical drawdown at face value. If your strategy has had a maximum drawdown of 30%, that is not the worst it can get. That is the worst it has gotten so far. The real maximum drawdown is unknown. So plan for significantly worse if history shows 30%, size for 45% or 50%. As they say, the drawdown you haven't seen yet is almost certainly still ahead of you. Factor that number along with Kelly percentage and see if you will be able to survive that with your allocation. 3. Use fractional Kelly, half Kelly or quarter Kelly. Now, Kelly is a reasonable starting point. What this essentially means is if baseline Kelly percentage says you can bet 40% of your capital, you can use half Kelly to size lower, use only 20% worth of sizing. Most professional traders use 25 to 50% Kelly as their default. It captures most of the compounding benefit while keeping drawdowns manageable, while also providing a large margin of safety against edge misestimation. And for discretionary traders and investors, well, you can use Kelly more as a mental model. I'm sure Buffett has never calculated a Kelly percentage because he cannot. But Ed Top observes in the book A Man for All Markets that Buffett's approach is consistent with Kelly's thinking. When Buffett and Munger were managing close to $200 million, they concentrated most of it in just 5 positions. Sometimes Buffett bets 75% of his fortune on a single investment, investing heavily in extremely favorable situations. That, in a way, was aggressive Kelly, but without the formula. The key question Kelly asks is, how strong is the edge and how asymmetric is the payoff or the win-loss ratio? Once we answer that honestly and size accordingly, while we keep to conservative sizing, we are pretty good. After all, the cost of oversizing is always worse than the cost of undersizing. And as Buffett said, in order to succeed, you must first survive, and that's more true for trading than for investing. Before I wrap up, if this episode sparked a curiosity to go deeper into the concept of Kelly Criterion, its origins, its mathematics, and the extraordinary cast of characters who took it from a Bell Labs paper to the trading floors of Wall Street, here are two books I genuinely recommend. The first is Fortune's Formula by William Poundstone. This is the book. It tells the full story of how Kelly's idea traveled from information theory to blackjack tables to hedge funds, through characters like Claude Shannon, Ed Thorpe, and some decidedly colorful figures from the world of organized crime. It's more like a thriller. You will not feel like you're reading a book about mathematics. The second is A Man for All Markets by Ed Thorpe, the man who actually took Kelly's formula and used it to beat blackjack, beat roulette, and then beat Wall Street. This is his memoir. It is part autobiography, part trading masterclass, and the chapters on position sizing and risk management are as practical as anything you will find in any good finance book. Links to both are in the show notes. So yes, that brings me to the end of this episode, and I hope you found this useful. Before I close, I wanted to share something. So it's been close to 6 months since I started doing these videos and the stories on this channel in the Money by Zerodha. Whether you've been watching from the beginning or this is your first time here, I would love to hear your feedback. That is, if you found the content valuable or is there something different that you would like to see. Do leave your comments below, and it really helps us get better. Thank you. Until then, take care and trade safe. I'll be back soon with the next one.